One of the most recognizable brands in the world, Nike, has seen its stock crash by 55% from the all-time high. This might prove to be the best buying opportunity for Nike stock in decades. In fact, super investors like Bill Ackman just bought more than $1 billion of Nike stock. But should you buy Nike for your stock portfolio? The company is a top dividend growth stock, and they just announced an 8.1% dividend increase. That marks the 23rd consecutive year that Nike has increased its quarterly dividend. And now, Nike is on its way to being a dividend aristocrat. And with the latest crash in stock price, Nike is currently trading at one of the highest starting dividend yields in the past decade. These are levels not seen since the great financial crisis. In today's video, I'm going to do a full stock review on Nike. That will include a look at the company's history, competitive advantage, how they make money, and a full stock breakdown. I'll even share analyst price targets and an intrinsic value estimate. Is Bill Ackman right to buy Nike now? And should you? Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock research platform, which is available at dividenddata.com. This is designed to save you time and help you invest smarter. Just ask a question to my new AI investment analyst, and you can get a detailed response with real-time financial data. You can write investment reports, summarize earnings, identify key business metrics, and find stocks that fit the exact criteria you're looking for by filtering by hundreds of possible financial metrics. On top of that, you get great data visualizations so that you can understand the trends impacting a stock's financials. If you sign up today, you can get 50% off dividenddata.com for life. This is to celebrate the launch of our new AI tool. Just click the link in the description and pin comment, and you can get the sale directly, or create an account on the web app, select your plan, and enter the promo code AI at checkout. That's the 2 letters AI, and you'll get 50% off for life. This is the best deal we will ever offer. With that said, let's get to the video. Nike, ticker symbol NKE, was originally founded in 1964 as Blue Ribbon Sports. The company changed its name to Nike in 1971, and since then they have been focused on the design, marketing, and selling of athletic footwear and apparel. And like most success stories, it took decades and decades to build. If you want to learn more about the company's journey, then I suggest reading Shoe Dog, which is a memoir by the founder Phil Knight, or watch the movie Air, which is a biographical film discussing how Nike landed the massive shoe deal with Michael Jordan. But if you really want to understand Nike's business and how they became successful, it's all about the brand. When Steve Jobs returned to Apple, he knew that he needed to fix their marketing and brand. And in this talk, he used Nike as a model of a great brand.
One of the greatest jobs of marketing in the universe has ever seen is Nike. Remember, Nike sells a commodity. They sell shoes. And yet when you think of Nike, you feel something different than a shoe company. In their ads, as you know, they don't ever talk about the products. They don't ever tell you about their air soles and why they're better than Reebok's air soles. What does Nike do in their advertising? They honor great athletes and they honor great athletics. That's who they are. That's what they are about. Apple spends a fortune on advertising. You'd never know it. You'd never know it.
Nike sells a commodity. There are no real competitive advantages you can have in shoes and apparel. Theoretically, it should just be a race to the bottom in terms of price. But the differentiator is brand. And it's about getting this Nike swoosh to mean something. Something so that you choose to buy it and wear it. And for Nike, that's honoring great athletes. And while the athletes have changed over time, the basic playbook has remained the same. Nike's marketing is actually so great that it has become a major case study in business schools for decades. But the flip side of that is now a lot of businesses know the playbook. You have stiff competition from the likes of Adidas, New Balance, and all these other brands you likely know. And also in the athleisure clothing space, Nike is facing stiff competition from rather newcomers like Lululemon. They've grown to be a $41 billion company, and Lululemon has seen earnings surge in the exact same years where Nike's earnings have flatlined and even declined. But before I get to the competition and the reasons for Nike's recent poor performance, let's understand how Nike actually makes money. The number one product segment is footwear at 64.8% of revenue. Over the past year, that has generated $32.4 billion of revenue. The number two segment is apparel, which is $13.4 billion, or 26.8% of their business. And at 4.3%, they have Nike branded equipment, which is $2.15 billion. And finally, at around 4% or $2 billion of revenue, they have Converse. Converse is an iconic shoe brand in its own right. And a pretty important part of the story for Nike's business model is their distribution channels, and that has changed a lot over time. You have Nike Direct and Wholesale. So Nike Direct is all their direct-to-consumer channels. That includes Nike-owned stores physically and digital platforms, whether that's their website, app, emails, etc. In Q1 2025, which was the latest quarter, revenues from Nike Direct were $4.7 billion. So that's about 42% of their quarterly revenue. It should also be noted that Nike Direct is down 13% year over year. The larger distribution channel for Nike is Wholesale. However, it should be noted that this used to be the entirety of their business. Nike's digital platforms have expanded massively, especially since the pandemic. Revenue through wholesale partnerships and other retailers was $6.4 billion in Q1 2025. That was also down 8% year over year. But as we back up again, remember that Nike is mostly their footwear business and then also their apparel business. Both of these have been growth businesses over the past decade. Nike has grown the revenue of footwear from $14.6 billion in 2013 all the way to $32.4 billion over the trailing 12 months. Apparel has grown from $7.4 billion all the way to $13.4 billion over the trailing 12 months. It should also be noted that these two largest business segments are actually their biggest growth businesses over the past decade as well. However, apparel revenue has been flat since fiscal 2022, and footwear revenue has been flat to actually slightly decline over the past year and a half. And it's these revenue declines that are the number one reason why Nike stock is down. All the way through 2021, Nike was on a track record of incredible growth. So the stock price was pricing in high future growth rates. However, when growth of revenue and earnings came in flat and actually started to decline, the stock price got cut in half. And this is something we should all keep in mind when investing. Expectations of future growth rates is the number one determinant in the valuation of a stock. If you're expecting high future growth, then it makes more sense for the profit and revenue multiples to increase. But if you're not growing, then those multiples need to come down. So why is revenue down? Well, one of the reasons is that they have seen traffic declines across Nike Direct, particularly on Nike Digital. And that is something the company was so hyper focused on during the pandemic because they grew that business to be so much larger then. But now that we're back in normal times, people don't shop only online. Other problems cited by Nike are intense competition in the athletic footwear, apparel, and equipment markets. And this makes a lot of sense. There is more competition than ever in these spaces. And I have not seen this directly from Nike, but I remember hearing reports that Nike's intense focus on their online digital business resulted in them losing focus on their wholesale partners and stores. And they actually ended up losing some shelf space and allowing new competition to flourish, such as Lululemon. It's hard to imagine that a lot of this growth in Lululemon's athletic wear business, a lot of that might have come out of potentially Nike's business, or at least Nike's potential growth. The number one problem at Nike is growth. It's all about growth. And in an attempt to restore the company towards growth mode, they are undergoing a CEO transition. The new CEO is Elliott Hill. This is Elliott Hill, by the way, and he's actually someone who worked at Nike for over 3 decades. And before retiring in 2020, he was the president of Consumer and Marketplace, leading all commercial and marketing operations for Nike and the Jordan brand. So he was there and knows what worked in the decades of prior Nike growth. And he was also there prior to their all-in digital strategy. So I have a feeling he'll be hyper-focused on reinstating growth in that wholesale distribution channel, which is still still the majority of Nike's revenue. And if you can get that side of the business to high growth again, then you're off to the races. So let's do an updated stock analysis on Nike. Nike, ticker symbol NKE, is currently priced at $77.39. Over the trailing 12 months, they've earned $3.49 in GAAP earnings per share, which puts them at a 22.1 P ratio. The current annual dividend payment was $1.48, but they just today announced that 8.1% increase, which will make the forward-looking annual dividend payment actually be $1.60. So the starting dividend yield would actually be 2.06%. This will be reflected in the coming days on dividenddata.com. The news just came out as I was making this video. And here you can see this long track record of growth at Nike of earnings per share and stock price. And as I mentioned earlier, once growth stalled and started to decline, the stock just fell off the cliff. And that makes complete sense. But the question is whether growth comes back at Nike. And if it does, then this might be a great buying opportunity. Historically, Nike has grown revenue per share at a 10-year compound annual growth rate of 7.96%. In fiscal 2024, that was only up 2.5%. And so far going into fiscal 2025, they're on pace for declining revenue. Net income per share has grown at a 9.44% 10-year compound annual growth rate, and this has basically been flat since 2021. Free cash flow per share has grown at a 13.76% 10-year compound annual growth rate, and you can see that the long-term trends for Nike's free cash flow are very strong. In fiscal 2024, they generated $6.6 billion of free cash flow. And what do they do with all this money? Well, they return it to shareholders via stock repurchases and dividends. Nike has a very long history of dividend growth. The 10-year compound annual growth rate of Nike's dividend is 11.92%. This has stayed high even in recent years. The 3-year CAGR is 10.4%. And as I mentioned earlier, they just announced an 8.1% increase, which is not yet fully reflected in my data on dividenddata.com. Nike is a quarterly dividend payer that consistently grows their dividend on an annual basis. And in my opinion, that latest 8% dividend increase signals that Nike still feels very strong about their free cash flow. The Nike dividend payment is sustainable with a 32.7% free cash flow payout ratio and 38% earnings per share payout ratio. Nike also buys back stock consistently. Over the past 2 years, they've decreased the shares outstanding by an average of 2.5%. This increases the relative ownership stake of all existing shareholders. The Nike balance sheet is strong too. They currently have $13.9 billion of shareholder equity. That includes $10.2 billion of cash and short-term investments and $1.8 billion of net debt. That is a company's total debt after accounting for their liquid assets, meaning their cash and cash equivalents. Nike is a free cash flow machine, and the Nike brand remains strong. I see no reason why Nike can't get back to their track record of growth. Analysts are projecting that as well. Earnings per share is expected to decline by 25% in fiscal 2025, which is pretty dramatic. Hopefully they can cut those losses back a bit. And remember that we're already in Nike's fiscal 2025. They actually have Q2 coming up in the next few weeks. But analysts are then projecting the company to return to double-digit earnings per share growth from there. 16% in 2026, 14% in 2027, 11% in 2028, and 15% in 2029. That would give the company a 16.5 P ratio based on current prices in 2029. And according to 34 Wall Street analysts, Nike stock appears to be undervalued. For November 2025, the high price target is $120. The consensus price target is $91.58. However, the lowest price target is $57. So based on the consensus price target, Nike stock is 18.3% undervalued. That's a pretty strong margin of safety for a high quality dividend growth stock like Nike. However, if we do a discounted cash flow analysis, it actually puts the implied share price at $56, which is in line with the lowest price target on Wall Street. That would make the stock 25% overvalued. And by the way, on dividenddata.com, you can do a discounted cash flow analysis and it autofills this giant calculator for you to use, and you can edit the growth rates to fit your need. So here you can see what it defaulted to. However, it does not project revenue growth past 2028. And if I use my analyst estimates for growth rates and I use those updated growth rates, then it actually puts the implied share price at $61.18, which still implies it's 19% overvalued. But again, there are a lot of metrics to play around with here in order to try and get an accurate valuation. For example, if we assume that Nike returns to their EBIT margin found in 2022, which is definitely something that's very possible, then Nike's implied share price will go up to $73, which is only 3% overvalued. Also, as I was diving into this, I thought the growth rate that they had for CapEx was a little more than I would expect. So I put it at 1.5%, which is what it was in fiscal 2024. And with that lower CapEx, the implied share price is now $79.87. So that would imply that the stock is 5% undervalued at the current price. So based on my analysis today, I would argue that Nike is a great business trading at a fair valuation. Throughout its history, Nike has been a fantastic stock to own. The total return since 1990 has been 13,591%. That is insane. And during that 2021 high, that was over 30,000% total return. And this has been far worse over the past decade at only a 76.38% total return. But still, that's after the stock fell 55%. In conclusion, I think Nike is one of the top dividend growth stocks you can buy now. And I actually just made a video last week going over 15 top dividend growth stocks that you can buy and hold forever. Nike was one of the ones on the list, and as I was going over it, that was one of the reasons I made this video. And again, Bill Ackman, who's an incredibly successful investor, also thinks Nike is a good buy. He now owns $1.44 billion of the stock, and 13 million of those shares was just in this last quarter. This is a new position for him. If you enjoyed the video, please leave a like and subscribe to the channel. I'm going to have lots of great stock analysis content coming out. And again, if you want to use the research tool I showed throughout the video, then sign up at dividenddata.com. This entire tool is a resource to help you save time and invest smarter. Because if you buy just one slightly better stock and it improves your return, then the tool more than pays for itself. And I want people to try out my new AI investment analyst where you can ask any stock question. And if you sign up today, you can get 50% off for life. And this is the best deal I will ever offer. Just click the link in the description or pin comment to get the sale directly, or create an account via the web app, select your plan, and enter the promo code AI at checkout. Thanks for watching.